When people ask me what my overall investing style is, I always tell them that it's tactical investing through volatility targeting. Now, I'll explain what that means with real examples today, but in my opinion, this is by far the best way to get a long-term market-crushing rate of return. And my track record for over 12 years since launching VTS officially in January 2012 proves that. Now, I don't always get it right. There are times of underperformance, but I'll go head-to-head against any other investing style out there over the long term. That's really when tactical rotation starts to shine. This is our defensive rotation strategy, and the way it works is I analyze a large data set of volatility metrics and then I divide the market into different risk sections. When our volatility metrics are in the stable range, this is when we want to get aggressive and we'll be holding the 2 times NASDAQ QLD. When volatility metrics elevate and risk is rising, we cycle into our safety positions of XLU utilities. And when the market is full on crashing, we'll be fully on the sidelines in cash. So you can see how we're tactically rotating into the position with the highest probability of success given the current volatility levels. Now with a live example, I'll show you exactly how this works in real time. So this right here, this is the 2 times NASDAQ ETF, the QLD over the last 9 months. Now if we check my strategy page really quickly, we can see that we actually entered the QLD all the way back here on this date, November 1st, 2023. If we look at where that is on the chart, that's actually all the way back here. So we have held the 2 times NASDAQ all the way, and we've actually made a 43% return. But recently, as we know, the market is actually starting to take a nosedive. Obviously, traders would have wanted to exit out into safety. We don't know what's going to happen going forward, but it could get pretty bad, and that's the point of moving to safety. We'll get into that soon. But if we look at the strategy again, when did we exit back into safety? It was right here on April 16th. So that on the chart is right here. Now, as far as the tactical rotation part, on that same day, April 16th, which is actually right there at the bottom, that's when we entered the XLU position. The reason we do this is because when volatility metrics start rising, historically speaking, utilities have far outperformed the NASDAQ index. This is our safety position. So if we go back to the QLD here and we zoom in, the fact that we exited right there and we went to utilities, we exited the QLD at a price of $82.55 and it's currently trading at $75.88. That's a drop of 6.67% that we avoided by moving to safety. And then on the XLU side, again, zooming in here, we entered right here. The price we bought in was $63.10 and it's currently trading at $65.43. That's a gain of 3.69%. So we saved 6.67% by moving out of the NASDAQ when risk was rising, and we gained 3.69% by moving into utilities because they outperform the stock market when risk is rising. That's a round trip difference of 10.36%. Now that's great, and we actually feel pretty good about our decisions right now, but we're not tactical investors because we're trying to make an extra 10% over a few days. Some of that could reverse next week. Who knows? That's not what our purpose is. The reason we're tactical investors is because at some point, the market is going to crash a lot more than it has this week. The S&P 500 is only down about 5% so far, but at some point, it's going to go down 15 or 20%. It's not that uncommon. And maybe once every 10 years or so, it's going to go down 50% or more and take many years to recover from. Remember, on an inflation-adjusted basis, after the dot-com bust, the S&P 500 took 16 years to recover from that crash. Do people really believe this isn't going to happen again? I would say, if anything, the government and the Fed are even more reckless these days. I'm not so sure the next crash won't be even worse. It very well could be. We're tactical investors because we simply can't afford to suffer the brunt of that drawdown, and quite frankly, you can't either. This is our tactical volatility strategy, and same thing here. I'm using a unique set of volatility metrics to gauge when we should be allocated to short volatility, when we should be exiting to safety and holding our GLD gold positions, and then when we get those signals that the market is all out crashing, we'll be in long volatility and actually making money when everyone else is watching the market go down in horror. So again, same thing here. This is just the internal trade signals, and you can see our original entry point to getting into the short vol trade was right there. That's November 1st, 2023. Now, these signals are actually geared to be a little bit more sensitive. Of course, the short volatility trade has an additional layer of risk there. Can actually go down faster than the stock market. So we had a couple of days here and there that we exited, but basically we've just been riding the short vol trade all the way until exiting on April 8th. So checking that out on the chart, this is the SVXY that we use, and our entry was all the way back there on November 1st. We rode this long trend, made a nice big profit, but we exited on April 8th, which is right there. Now going down a little bit is fine. You actually want to allow for that. Sometimes the market does go up and down a little bit, but you don't want to ride things all the way. That's the whole point. And of course, we know at some point this is just going to fall off a cliff. So we exited right there. If we zoom in, our exit price was 109.65, but there was a 2-to-1 split recently, so that's actually half that at 54.83. The current price is 51.48, which means we saved ourselves 6.12% so far. But remember, this strategy is tactical and we moved into gold. So we can see here, April 8th on the gold trade is right there. Our entry price was 215.51 and it's currently trading at 221.03. That's a gain of 2.56%. Same thing here. By being tactical, there was actually a significant savings on that change of position. We avoided 6.12% on that SVXY position. We gained 2.56% on the gold entry. And in total, since April 8th, the strategy has actually saved 8.68%. So great. Again, I'm very happy about that. But it's not about that 10% difference over a couple of weeks. Short volatility is my favorite trade. I'm the volatility guy. But there are times when it crashes so fast that you don't want anything to do with short volatility. That's why we have to exit to safety gold. And in extreme conditions, we have to go full on long volatility so we can actually make a profit when the market is melting down. Tactical investing allows us to ride the best parts of the stock market, but also reduce those extreme drawdowns when necessary. Volatility targeting is how we decide when those breakpoints happen. Short volatility is awesome. Lots of money can be made in good times. But you have to know how and when to get to the sidelines before the real damage is done. The truth is, most people do actually know what to do about 70 to 80% of the time. It's been a nice long bull market run and people are pretty happy with their accounts right now. But at some point, the party is going to stop, and I suspect quite violently. If you want to learn more about my style of tactical investing through volatility targeting, there's a free trial down below or also on my website. You can see our full portfolio, all the trades, the course library, the volatility dashboard, and you can decide if VTS is the right fit to help you avoid the market turmoil that is coming. This video here will explain all about our flagship volatility strategy at VTS. You can learn all about the short volatility trade. This video will explain my comprehensive volatility index that I created that's based on all of these volatility metrics that I talk about. I invite you to continue down the volatility rabbit hole. Thanks for watching.